Coming up in today's video, UBS, the Swiss bank, dropped their annual bubble index. No surprise, we were number one last year. Still on the list. They're calling us a high-risk bubble city. The cracks are in the foundation. You know what I say to that? I'm tired. Tired of the negative. The media spins on this great city, saying these prices are at hand. Affordability crisis. You know what I gotta say to that? Obviously, it's a crash happening. Geez, no one can afford these prices. Buy today, all of a sudden you're up 100 grand in 24 hours. What kind of ridiculous is that? Oh. Let's talk about it, guys. Today, we're talking about the index. We're on the list. Vancouver's on the list. Let's talk about it coming up in today's video. Pow! Alright, Michael J. Black, welcome to the channel. If you're new to the channel, make sure you subscribe for more market updates regarding Toronto real estate. Now, today we're talking about UBS, the Swiss bank, dropped their annual bubble index, which is basically they track, international cities, and they build this index that basically labels who's got a high risk of a bubble. Now, Toronto, we were number one last year. No surprise, we're still on the list. And essentially the top cities are Hong Kong, Munich, Toronto, Vancouver, London, and Amsterdam. So they have the highest risk of a bubble. Now, basically, I'm going through this report. It's not as bad, definitely not as bad as last year. And there is some, in my opinion, there's a light at the end of the tunnel for Toronto real estate. Now, the main thing is the affordability crisis for these top cities is at some point it's so expensive and you pretty much cannot afford to buy without some, definitely in the major city core, without some, a pretty large sum of inheritance money. Now, we're seeing this because when we do our surveys and when Toronto Real Estate Board does their surveys and they're finding out first-time home buyers, are putting down the 20%. And you got to ask yourself, how are they affording first-time home buyers affording 20% down in our market when, we're hitting, if it's a condo market, you're looking at over 500,000 purchase price on a, low density in terms of semi or, detached, you're looking at close to $1 million. So 20% down on that would be 200,000. Now, obviously, where everybody's getting that money is definitely from an inheritance or some sort from their family. So we are seeing that. Also, when we go through this report, the increase in rent in these cities is gone up quite a bit. And because of that, more and more money from, everyone's income is going, higher percentage is going to the rent. So when they're evaluating these markets, these are some of the things that they're focusing on. And the main topic in this report is affordability. Now, when it comes to the top two cities in Canada that we're on the list is Vancouver and Toronto. Now, Vancouver has been, their index score has been actually trending up, and it's actually ballooning up towards, they're trending up. And that's because they basically have seen double digits over the last couple of years, and they continue to move up. Now, in Toronto, on contrast, is declining, which is definitely more positive than not, because you definitely want to be trending down when it comes onto this index. Now, when they're looking at these markets, the reason why they're up here is because we haven't seen a market correction really since 1990. So since then, the markets have continued to gone up, regardless of the financial crisis that happened in 2008, and as well as weakening commodities. Pricing has not affected the real estate. So for that reason, we trend really high in terms of on this list. Now, the big factors when it comes down to what's going to tilt Toronto real estate, and obviously Vancouver's in this too, is interest rates, which has the biggest impact on any market around the world. Increasing interest rates, policy changes. So we've already seen many changes since the fair housing market plan, which, like I said, foreign buyer tax, vacant lot tax, you know, just a bunch of different policy changes, you know, strict rent control. All these things have a huge impact, and that will eventually, you know, definitely have cooled the market down, but have long-term, you know, effects on the market. Now, also with a weakening dollar, you're going to see at some point this market becomes interesting for foreign money to come in. So as our dollar trends down, you're going to see more and more people, regardless of foreign buyers tax and stuff implications. There's always ways around this stuff. So, you know, you're going to still see some money coming in, which again might drive the market. And then at some point, you know, tipping the scale even more further down on this index. Now, when it comes down to analyzing and comparing the markets, what UBS does is benchmark pricing in terms of what it takes for a skilled worker to be able to afford a 650 square foot flat in their city. So essentially, we're number 14 on this list of the major cities. Now, in comparison, it takes 7 years for us, for a skilled worker to afford that. Now, comparison to like Hong Kong, which is number 1, 22 years. So you look at those comparisons, we're looking pretty good. Now, on the low end of the scale, Chicago, very undervalued market, it's only taken 3 years. So when you compare it to that, you know, it's more than double, but again, we're considered high risk on this list. More interesting data that they cover is price to rent. Now, essentially, they analyze these markets, the cost, if you rented out your flat, how long it would take to pay off. Now, Toronto landed 15, where it's taking 25 years to pay off. In terms of on the high end of the market, you're looking at Zurich, that's 35 years. Chicago, 12 years. So again, we're twice as high as Chicago, you know, but getting up there in terms of on the high end of the scale. Now, typically, when these markets are so high like that, it's taking more years. Investors coming into this market want to see capital gains pay off their dividend, right? Because at some point, if it's taking you 50 years to pay off your investment, you want to see, the only reason you get into that market is because you see potential of the capital gains to offset your rent. Because if your rent's not even covering your mortgage and expenses, at some point you definitely want to see a return. So the higher you go up on the list, like I said, investors want to see that capital gain. So as soon as that starts to slow down, investors are going to start pulling out. Like all in all, with Toronto being on this list, not as bad as, you know, definitely last year. We are, you know, in the last 4 quarters, we've seen a cooling off since the fair housing market plan. Now that was our foreign buyers tax, you know, stricter lending, interest rates going up. All these playing obviously into our cooling off our market, which is obviously allowing us to trend down on this list. Now, I think next year we're going to continue to see this list, our index score go lower and lower, just because, you know, where we're at in our market, you know, I just don't see big jumps happening because like interests are continue to go up. You know, we are very low in terms of money lending, and like I said, the governments and, you know, the Canadian bank, they're watching and making sure that they do not, you know, put interest rates up too high too fast, because they do not want to see a big drop in the market. So they're trying to stabilize accordingly. I feel that we're going to continue to trend down on this index for next year, but it would be interesting to see where we do land. You know, all in all, we're on this list because bottom line is, when you factor in inflation, over the last 5 years, our real estate's up over 50%, which is extremely high, extremely fast. But with all the new stuff that's coming with the companies and, you know, like I said, with the tech boom and all that that's happening in Toronto, you know, I do not see a market crash, you know, happening in the next little while. To me, it's just going to stabilize and then slowly continue to go up. That's just my opinion. I'd love to hear what you think. Like, comment, share. And subscribe if you haven't, guys. We'll catch you on the next video, all right? Take care.